All right, if you're running a business in Malaysia, you know that keeping an eye on your expenses is everything. But what if I told you that some of the money you spend on your business, you actually can't deduct from your taxes? Yep, today we're diving deep into Section 39 of the Income Tax Act. Think of it as the ultimate guide to what you absolutely cannot claim.
So let's start with a big question, one that every single business owner has asked at some point. Hey, I spent this money for the business, so I can deduct it, right? Well, you might be surprised to hear that the answer is often nope. This is a huge misconception, and honestly, getting it wrong can cost you a lot of money.
Okay, so where do we even start? It all begins with what's called the Golden Rule, which comes from Section 33. It says an expense is deductible only if you spent it wholly and exclusively to make money for your business. Sounds pretty straightforward, doesn't it? Well, here's the thing. That's only half the story. And now it's time to meet the star of our show today, Section 39. If Section 33 is the rule book, think of Section 39 as the big, bold, powerful exception. It's basically the government's official do not deduct list. And here's the kicker. It overrules the Golden Rule. It doesn't care how important that expense felt to your business. If it's on this list, it's out.
And this is where things get interesting. You've got Section 33 giving you the green light, saying go ahead, deduct anything that helps you make money. But then, bam, Section 39 throws up a giant red stop sign. It doesn't matter if that expense directly led to a huge sale. If it's on the Section 39 list, it is non-deductible, period. End of story.
So you're probably thinking, how on earth am I supposed to remember all this? Don't worry, we've got a super simple trick for you. Just remember this little acronym, PCFTED. It stands for Private, Capital, Fines, Tax, Exempt Income, and Donations. This is our guide for the next few minutes, so let's break it down. All right, first up in our PCFTED guide is P for private. This one's a biggie. The law draws a really firm line in the sand between your business life and your personal life. Anything that's a private or domestic expense just can't be claimed. Now, this might seem obvious, but you'd be surprised how blurry the lines can get. We're talking about trying to claim your personal groceries, your home internet bill, or that family vacation you tried to pass off as a business trip. Even a fun team outing for staff that has no real business purpose, that's a no-go. And trust me, the tax authorities are looking very closely at this stuff. Okay, next letter, C for capital. This one is absolutely crucial to understand. So, what's a capital expense? It's when you buy a big-ticket, long-term asset, something that's going to benefit your business for years to come. This is totally different from a revenue expense, which is just your day-to-day running costs.
So think about buying an office building, a huge piece of machinery, or a new company van. You can't just deduct that entire cost in the year you buy it. Instead, you get to claim the cost back bit by bit over time through something called capital allowances. It's a whole different process.
Moving right along to F for fines and penalties. The logic here is super simple, right? The government is not going to give you a tax discount for breaking the law. It just wouldn't make sense. This covers everything you can think of, from simple traffic tickets for your delivery trucks to much bigger environmental fines, or really any penalty that's imposed under the law. The rule is simple. If it's a fine, you can't claim it. Next up, T for tax. Now, this one might make your head spin a little because it's kind of circular. Think about it. You're calculating your taxable income to figure out how much tax you owe. It makes no sense to then deduct the tax itself from the income you're calculating it on. A better way to see it is that tax isn't an expense to earn profit. It's what you do with the profit once you've earned it. And just to be super clear, this isn't just for Malaysian corporate tax. Any income tax you pay, even to a foreign country, is not deductible. Okay, we're on to E, which stands for expenses related to exempt income. This one really just comes down to fairness. If you have a source of income that you don't have to pay tax on, then it's only fair that you can't deduct the expenses you had to spend to get that income. A perfect example is dividends from some Malaysian companies. They're tax exempt. So if you paid a financial advisor some fees to help you get those dividends, you can't deduct those fees. The logic is simple. No tax in, no deduction out. And last but not least in our acronym, we have D for donations. Now, the government absolutely wants to encourage businesses to be charitable, but there's a big catch. For your donation to be tax deductible, it has to be to a charity or fund that is officially approved by the government.
So in practice, this means any money you give to a charity that isn't on the approved list under Section 44(6) is a non-approved donation. And that means, you guessed it, no tax deduction. The big takeaway here, before you donate, always check if that charity is on the approved list. Okay, let's make this real. We're going to look at a quick case study for a company called ABC Sindarian Berhad. Let's look at their expenses. First up, salaries and wages. Totally allowable. That's fine. What about this $500,000 for an office building? Nope, that's a capital expense. Traffic fines? Definitely a penalty, not allowed. Staff team outing? Uh-oh, that falls under private. But look here, a donation, and it's to an approved charity, so that one gets a thumbs up. Let's zoom in on that huge 500,000 ringgit for the office building. This is a textbook example of a capital expense. I mean, can you imagine if they tried to deduct that whole amount in 1 year? It would completely throw off their taxable income. This is precisely why the separate system of capital allowances exists. And then we have the 3,000 ringgit in traffic fines. It's obviously a much smaller amount than the building, but the rule is just as strict. It makes no difference that the company drivers got these fines while they were out on business deliveries. A fine is a fine, and you can never, ever deduct it. Okay, so let's wrap this up. What do you absolutely need to remember? First, Section 39 is king. It's the trump card that beats all the other general deduction rules. Second, those big categories, capital items, fines, taxes, and any personal costs are always off the table. Third, remember that fairness rule. No deduction for expenses that create tax-free income. Really, it all boils down to this. You have to categorize every single expense correctly. It's absolutely crucial for staying compliant. And that brings us to the final and maybe the most important question of all. Now that you know the ins and outs of Section 39, I want you to go and take a good, hard look at your own company's books. Is every single expense in the right place? Ask yourself honestly, are you audit ready?